Welcome to the Deep Dive. Today we're getting into IAS 2. That's the standard all about inventories.
Yeah, basically how companies account for the stuff they plan to sell.
Our aim here is really to break it down, pull out what you need to know about how inventory hits the financial statements.
Exactly. IAS 2, it provides the rules for figuring out the cost of inventory, making sure it's recorded as an asset until, you actually sell it.
And then it becomes an expense.
Right. And the standard covers how to determine that cost, what to do if the value drops, that's the write down to net realizable value bit, and the different methods or cost formulas allowed.
It's been around a while, hasn't it, since 2001?
Adopted then, yeah, with a key revision in 2003. And then some smaller tweaks later on just to keep it aligned with other IFRS standards.
Okay, so who does this apply to? Is it all inventory?
Pretty much. The big exceptions are financial instruments, totally different rules there, and biological assets like crops growing or livestock right at the point of harvest. That falls under IAS 41.
Right.
And there's a small nuance, too. For producers of things like agricultural products after harvest or minerals and commodity brokers, IAS 2 applies, but the specific measurement part might differ if they're already using net realizable value or fair value methods, which is pretty standard in those industries.
So the valuation approach might be slightly different in those specific cases. Makes sense.
No.
Now let's pin down inventory. What exactly counts?
Sure. Think of it as assets held for sale in the ordinary course of business.
Like finished goods on a shelf.
Exactly. Or assets in the process of production for such sale. That's your work in progress.
Right.
And finally, materials or supplies that you'll consume in the production process or in rendering services. So raw materials, too.
Got it. Three main types. Now, you mentioned net realizable value, or NRV. Why is that term important?
NRV is key. It's the estimated selling price you expect to get, but less any costs still needed to complete the item and the costs you'll incur to actually make the sale.
So selling price minus finishing and selling costs.
Basically, yes. And it's important to remember it's an entity-specific value. It's based on what that company expects, which isn't necessarily the same as fair value, which is more market-based.
Okay, and the fundamental rule here is inventory is measured at the lower of its cost and this NRV.
That's the core principle, exactly. Lower of cost and net realizable value.
So let's dig into cost. What all gets bundled into that?
Well, cost is quite broad. It definitely includes the purchase cost price, import duties, transport in, that sort of thing, but less any trade discounts you get back.
Okay. Purchase costs.
Then you've got conversion costs. That's your direct labor, obviously, but also a systematic allocation of your production overheads.
Overheads, like factory rent.
Yeah, both fixed and variable overheads based on normal production capacity. And finally, other costs can be included if they were necessary to bring the inventory to its present location and condition. Think maybe specific design costs for a particular customer order.
Are there costs that definitely don't get included in inventory cost?
Mm-hmm.
Things that are expensed right away?
Oh, yes, several. Things like abnormal amounts of wasted material or labor, those are expensed.
Right. Unexpected spoilage.
Exactly. Storage costs, too,
Right.
Generally, unless storage is a necessary step in the production process before a further stage.
Okay.
Admin overheads that don't contribute to getting the inventory ready, those are out. And selling costs are always expensed, not capitalized into inventory.
What about borrowing costs, like interest?
Good question. Generally excluded, but they might be included in very specific limited circumstances under a different standard, IAS 23, for certain qualifying assets, but usually no.
Okay. Now, tracking the cost. If you have lots of identical items bought at different prices, how do you figure out the cost of the ones you sold? Cost formulas, right?
That's where they come in. If your inventory items aren't interchangeable or they're for specific projects, you use specific identification. You track the actual cost of each specific item.
Makes sense for, say, custom machinery or something.
Exactly. But for most inventory items that are interchangeable, the standard allows two main methods: FIFO, first in, first out.
Assuming the oldest items sell first.
Right. Or the weighted average cost method, which averages the cost of all similar items. The key thing is, whichever method you choose, you have to apply it consistently for similar inventories. You can't just switch back and forth to manage profits.
Consistency is key. Okay, back to NRV for a second. When does a company actually have to write inventory down to that lower value?
A write-down is needed when the cost you've recorded is, well, probably not going to be recovered. Maybe the inventory got damaged.
Or it's just old, obsolete.
Exactly. Or maybe selling prices in the market have just tanked. If the expected selling price, less those completion and selling costs we mentioned, is now lower than what you paid for it, you have to write it down.
And how do they assess that? Item by item?
Usually, yes, item by item, although sometimes it's okay to group similar or related items together, like a product line.
And these estimates, they're based on?
Based on the most reliable evidence available when the estimates are made. And you do consider events happening after the period end if they confirm conditions that already existed at the period end.
What about raw materials, if their price drops?
Interesting point. Materials held for use in production aren't written down below cost if the final products they'll be used in are expected to sell at or above their cost.
So if the finished good is still profitable, the raw material cost is okay?
Pretty much. But if a drop in material prices signals that the finished goods will likely sell below cost, then yes, the materials might need writing down too.
And can these write-downs ever be reversed?
Yes, they can. If the circumstances that caused the write-down reverse, maybe selling prices recover, you reverse the write-down, the inventory value goes back up.
But only up to the original cost, presumably.
Exactly. The reversal is limited, so the new carrying amount is the lower of the now higher NRV and the original cost. You can't create a gain beyond reversing the previous loss.
Okay, so the inventory is sitting there, valued correctly. What happens when it's finally sold? How does that hit the income statement?
Simple, well, conceptually simple. The carrying amount of the inventory sold is recognized as an expense in the period you recognize the related revenue.
The matching principle again. Matching cost to revenue.
That's the one. And any write-downs to NRV or other losses like theft, they're also recognized as an expense in the period they occur.
And the reversals we just talked about.
They reduce the amount of inventory recognized as an expense in the period the reversal happens.
Got it. One last thing. What do companies need to tell us, the users of financial statements, of their inventories? Disclosures.
Yeah, disclosures are important for transparency. You need to see the accounting policies used, especially which cost formula, FIFO, or weighted average.
Okay.
The total carrying amount of inventory, usually broken down into categories like raw materials, work in progress, finished goods. Also, the amount of inventory carried at fair value less costs to sell, if any. The amount of inventory expense recognized during the period.
The cost of goods sold, essentially.
Mostly, yes. And details about any write-downs, the amount and the reason, and any reversals. Oh, and if any inventory is pledged as security for loans, that needs disclosing too.
Right, that seems comprehensive. So really understanding IAS 2 is pretty crucial for getting a real handle on a company's operational health.
Absolutely. It provides that vital framework to make sure inventory values aren't overstated and that costs hit the income statement at the right time. It helps reflect economic reality.
And understanding these principles can give you, the listener, some real insights. Which leads to a final thought. How might a company's choice, FIFO versus weighted average, actually change the profit number they report, especially when inventory costs are going up, or maybe down? Something to think about.
Definitely something to ponder. It can make a difference.
Thanks for diving deep with us today.
Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.